McDonald's is no longer winning because it has the best burgers. It's winning because it has the best system. The company is turning itself into a global food operating platform powered by data, automation, loyalty, and scale. That's the real story now. Revenue growth is decent, margins remain elite, and traffic is stabilizing after a difficult period for low-income consumers. But there's a catch. McDonald's increasingly has to spend more money just to defend its position. The company still looks dominant, but this stock only works if the machine keeps getting more efficient every single year. McDonald's recently posted 3.8% global comparable sales growth, with U.S. comps up 3.9%, mainly driven by higher ticket sizes and better traffic trends. Operating margins remain extremely strong at over 45%, although they slipped slightly because the company is leaning harder into value meals, promotions, and franchisee support. Cash flow remains massive thanks to the franchise-heavy model, where royalties and rent generate recurring income with limited operational risk. What changed is that McDonald's is no longer relying purely on pricing power. After pushing menu prices roughly 40% above 2019 levels, management is now forced to rebalance toward affordability, loyalty offers, and product innovation to keep traffic alive. That matters because this company depends on volume, not just pricing. This is not a cheap stock. McDonald's trades like a premium quality infrastructure asset disguised as a restaurant company. The valuation only makes sense if the company keeps delivering mid-single-digit sales growth, steady unit expansion, and margin improvement through automation and franchising. Investors are not paying for burgers today. They are paying for what McDonald's could become over the next decade. A globally standardized AI-assisted consumer platform with enormous cash flow stability. The current business alone probably does not justify a premium multiple forever. The future efficiency story does. If automation, loyalty expansion, and international growth slow down, the stock becomes expensive very quickly. McDonald's is trying to centralize everything. Data, operations, marketing, equipment, loyalty systems, and even kitchen workflows are being standardized globally. Management is investing heavily into AI tools, predictive systems, geofencing, digital ordering, delivery optimization, and automated restaurant operations. This is logically the correct strategy because scale becomes even more powerful when technology amplifies it. A smaller chain cannot spend billions modernizing restaurants and integrating AI across tens of thousands of locations. McDonald's can. But the risk is that the company slowly turns into a capital-intensive efficiency machine where expectations never stop rising. McDonald's still dominates most of global fast food because its scale is absurd. The company generates around $139 billion in system-wide sales and operates over 45,000 restaurants globally. Competitors like Chipotle Mexican Grill, Yum Brands, and Restaurant Brands International are strong, but they either lack McDonald's international reach, cost advantages, or operating consistency. Chipotle is stronger with younger consumers and healthier brand perception. Yum has better exposure to emerging markets through KFC. But McDonald's still wins on convenience, marketing power, supply chain scale, and average unit economics. The real competitive threat is not one company. It's changing consumer behavior around health, delivery, and value perception. The biggest risk is that McDonald's slowly loses pricing power while costs keep rising. Beef inflation, wage pressure, franchise tensions, and weaker low-income consumers can squeeze the system from both sides. Another problem is that traffic growth becomes harder once prices move too far above what customers psychologically associate with cheap fast food. There's also a long-term risk around changing eating habits, GLP-1 drugs, and growing demand for healthier food options. If traffic weakens materially, the whole investment thesis around operating leverage and automation starts to crack. The stock also depends heavily on execution because investors already assume McDonald's will remain one of the most efficient restaurant systems on earth. The upside scenario is very simple. McDonald's successfully turns its massive global footprint into a digital ecosystem that drives higher customer frequency, larger average orders, and lower operating costs. If loyalty memberships keep growing, AI improves restaurant efficiency, and international expansion continues in markets like China, India, and Indonesia, the company could compound cash flow for a very long time. In that scenario, McDonald's stops behaving like a restaurant stock and starts behaving more like a global consumer infrastructure asset with extremely stable recurring economics. That's when today's valuation starts looking reasonable instead of expensive. McDonald's is not a turnaround stock. It is not deep value. It is a premium quality compounder that now depends more on technology and operational efficiency than burgers themselves. This investment is for people who believe the future of consumer businesses belongs to giant ecosystems with scale, automation, loyalty, and data advantages. The company is still incredibly strong, but the easy pricing power era is probably over. From here, execution matters more than brand nostalgia. McDonald's is no longer selling fast food, it's selling consistency at planetary scale. I'll break down the next one soon. Subscribe if you want to stay ahead.